live. All right. Yep. Let's see. We'll get started here in 1 second here, guys. One second here, guys. We'll get rolling. Just trying to get Kyle in, and we'll get you caught up here. Okay. All right. Please. All right, guys. Welcome. We'll get rolling here. So busy market again. It's again, we're having technical issues with Kyle Zen. We will get the technology right at some point, but we're gonna continue on. We're gonna miss Kyle here today, but let's push forward nonetheless. All right, so today's the 31st, and we're gonna skip. Oops, we're gonna skip past that part. Last week I told you that we always start off with something like what's going on in Saratoga, and this was kind of funny one. So we were going to Seinfeld, and you gotta he's an icon. You gotta see him. So let me just pause this video so it doesn't autoplay on us, and I'll set it up.
Do you know that?
So Seinfeld was here. Through the whole thing, this was like we're having a heat spell in upstate, and it was like 100 degrees is going on. He's like, you gotta hydrate and you gotta drink water. That was kind of like an underlying theme of his whole show. And the whole time he's drinking Fiji water. And I'm like elbowing my wife and my friends. I'm like, I've gotta give it to him. You know me, I'm not really shy of the camera. I was like, I gotta give it to him that we're in Saratoga, like the home of Saratoga water, which is known all around the country. So he takes Q&A, and of course I had to give it to Seinfeld. I had my, he's somebody that, you like to, come on back over here. See if you can hear this. All right, I'll turn it up.
Do you know that Saratoga has the best water in the country?
Do I know that Saratoga has the best water in the country? Of course I know that.
You do? Why are you drinking
Because
Fiji?
you, like me, have tried every water everywhere in the country, and it's so easy to tell good water when one is better than another. I had Saratoga water. The same goddamn water as everybody else.
So he goes, it's the same bleep waters everywhere else, and everyone in Saratoga started booing. So of course I had to turn around, and we were up front and gave him a wave. You know me, not shy away from the spotlight. So yeah, I got to grill Seinfeld. It was kind of funny. I was looking forward to sharing that with you. It's been a great week, and again, I hate being late again. We'll get you caught up. I'll get caught up on the tech eventually as the team builds out, and I'm not trying to do everything at once here. But, it was a really good week at Inside Edge. The markets are great. I have so much to share with you, and I don't know. It's just, the more people that we talk to, I realize the more lives that we're touching, which is great. But, more importantly, that's what I love about this business, which is kind of different than the prior money management business, which is that our interests in this business structure are completely aligned. I would, more time, I do care more about my clients' money even more than my own money. There's many times I'm focused on, in the trading prior world, I'm more worried about getting the clients the notification to adjust positions accordingly, and then I'll take care of my own money later. So I care about the clients more, actually, that I would say, than my money. But here it's just a screenshot of here's all of our family money. And what's great about this is our interests are so perfectly aligned in that every portfolio that I build and positions are exactly what carries my kids' college money and my parents' money right here. I'm not obviously showing you account numbers or dollar figures or what, but I think that's a big thing that I really appreciate is how I would say transparent and how aligned and how much we put into the management of of these portfolios as well as the financial planning, because literally my family and my money is right next to yours, and I love that position. So I just wanted to share that with you. All right, so opening stuff aside, let's get into it. Fed was out and they struck kind of a little bit of a negative tone yesterday in terms of maybe we don't need to cut rates. And that's something that I've been saying for a while, and the market's selling off a little bit today. We were up a whole bunch after earnings that we'll talk about. And you can see it right here in the movement of the probability of the Fed dropping from the current Fed fund target of 4.25, 4.5 down to 4 to 4.25, dropping 25 basis points in terms of the target range. Yesterday, it was 46% chance of going down 0.25% in the September meeting. Now it's 39%. So here we go again. The market is starting to push out the first Fed rate cut. And Powell yesterday said, with tariffs that are inflationary and viewed to be inflationary, that's kind of preventing us from cutting rates, which, the glide path of inflation is lower to 2%. So he's like, basically, I think he otherwise said without tariffs, we'd be able to cut. And the market didn't love that. So here's the trajectory of rates. And, this is so key, I think, for equity market and obviously fixed income market investors, as well as the direction of Fed rates. And there's a lot of talk that, people want the Fed to cut rates and the equity market should give a boost. But, there's another way to think about that in that, maybe if the Fed has enough confidence in the economy, even with the tariffs, which deals are being done, we face another deadline with China, I think it's August 9th. If the Fed doesn't cut with that overhanging, that's kind of a boost in terms of confidence and where the Fed sees the market. And, if you, so far, you're like, Todd, I don't really know what you're talking about. Central banks are really one of the main key primary drivers of markets. And I learned that when I traded for a hedge fund back in 2008 and 9 on the FX side, right? Central banks, which, control the money and, control level of interest rates, that's the key driver of markets. And, our Fed, where they set the policy rate, that has so much of an impact throughout the entire economy in terms of borrowing costs and also planning based on the visibility where they go. And that's how, CFOs of corporates will plan out their spending, which is especially important in this big CapEx cycle with, so many companies, industries and sectors planning to spend on AI and hardware, as we're in this big boost. So, you can't understate the importance of where central banks set their policy. Okay. So we're right now at 60% chance of a cut in September. And then as of now, we're at 77.5% of another cut in October. All right, we'll see. I mean, this trades hour by hour, it could be pushed out. And again, I kind of take it where I think it's kind of a vote of confidence from our central bank, which is the Federal Reserve, that the economy is in strong footing. We did get the PCE this morning. This is the Fed's preferred inflation gauge, personal consumption expenditure, and it came in a little hotter than expected. Still unpacking this report. Obviously, we're prepping for this presentation here today. So 2.8% versus expectations at 2.7, and the prior was revised up to 2.8. So not great. 2.6, 2.7. It's close to the Fed's 2% target, but we need to see this start to come down. And what I did here is I took a screenshot of the S&P futures on a very short-term time frame. This is a 3-minute. Initially, we sold off in reaction to the number, moved up, and then this has been once the black shading comes in, that's when the New York Stock Exchange opens. We sold off, rallied back to a lower high, and here we are now. This is a 3-minute chart, so you're talking, within a half or 0.75% movement here. It looks like a crash, but it's a short-term day trading chart. But I like to look at the short-term time frame to see how the market reacts to it. So, we had some really good data out of earnings, which I'll talk about. Markets in potentially some pretty rare air. So, we'll see. So bigger picture, inflation expectations as measured by TIPS, which is Treasury Inflation Protected Securities, is very much under control here over the last 3-4 years. But you'll see just in the last couple months, we are getting a little bit of a bump up, which no doubt is the tariffs. I think if we can stay below expected inflation at 2.5%, I think that would be good. If we start seeing these tips, I'll track the 5-year tips and the 10-year tips. These are Treasury securities that are adjusted based on the reported inflation rate. If you start going 2.5, 2.6, 2.7, then you would say some technical resistance or ceiling is broken, and now the market's starting to price in more inflation than what would be comfortable with. And then if that's the case, you're going to continue to see those rate cuts pushed out. And then how does the stock market react to that? All right. So, it's a combination of earnings and an interest rate policy, which, it's not two on the equal level. Companies' earnings are certainly a function of where the Fed sets borrowing costs, which are interest rates. But, if earnings continue to be strong and the consumer can continue to be buoyant and support the economy, and earnings out of, American corporations continue to be strong, despite the higher rates, we should be okay for a while. All right. We did get GDP. When was it? Yesterday. Yesterday was GDP. This is the first reading of second quarter GDP. So what happens is the BEA will release 3 versions of GDP. So advanced reading, second reading, and then final reading, all within like a month and a half of each other. They'll go back and look at different metrics to see if the last reading was correct, and then they'll give us a final. So the most widely watched is the first reading, which it will be revised 2 more times, but it came out at 3%. Which is very solid. So real GDP increasing annual rate of 3% in Q2. And you look at, we had a contraction here in Q1, and then we rebounded sharply in Q2. Now, it was interesting as you jumped into this report. This is the contributing. These are the components, or how much consumer spending, investment, government, exports, imports contributed to the 3% Q2 reading. And there was a significant decrease in imports, which a decrease in imports and an increase, let me say this again, a decrease in imports and a decrease in exports will both positively impact GDP. Exports dropped just a touch, but imports, exports impacted negatively the GDP reading, but the imports by this positive bar added about 5% to the GDP, which means imports decreased. So a decreased amount of money that we send out of the country bringing goods in is going to positively impact our GDP. And the big reason is a pull-ahead effect ahead of tariffs. So this is right out of ChatGPT, which, I think sometimes is an effective way to look at things simply. So the decrease right here in imports is compared to Q1. Firms rushed to import goods in Q1 ahead of steep tariffs, right? So there was a big pull ahead in Q1 to import pre-tariffs. Now there's been a significant, reduction in imports because now tariffs are in place. So that helped boost Q2 GDP. All right. There's also, a seasonal impact here. Q2 saw a sharp reversal. Imports fell back towards seasonal norms. So it's not just all a pull ahead effect on Q1. There's seasonality as well. So the drop in imports in Q2 was not due to sudden trade blockages or new foreign transactions, but rather a correction after an early rush to import before tariffs were imposed. Okay. So it's a combination of seasonality and that pull ahead effect in Q1. And then the big debate yesterday with Powell is, is it going to be, these imports going to be a one-off impact or is it going to be an ongoing impact? And the answer to that is still uncertain. So we really need to continue to watch GDP, which is going to be very important, obviously, as well as Fed rate policy. So I've had this chart up for a couple times, getting off the fundamentals and the macro and going right to the technicals. And I think it's important to remember, back in my old lives, looking at the models, the technical models of the stock indexes. This is the NASDAQ composite, looking all the way back to the turn of the century. And the model that we look at says we're still in a secular bull market. So my 24 to 36 month target should be this at about 26,000. This clustering of ratios that are used to measure the different swings within this model that we look at. And then ultimately, I would say it's a decade target, up around 46 to 50,000. Okay. Now, the first pair of ratios right here did cap us and then set up the Q1 at 25 sell-off before we came back. So we certainly respected that before, I think ultimately we should test this. And, that's going to be a pretty significant move, which is going to be more than a double from here. There's no guarantees. We won't go straight there. I could be totally wrong, but this is a model that's been used for 75 to 85 years, by many prominent investors. So this is the weekly chart, a little bit more zoomed in. We broke above this resistance. I think the near-term target, we're at 21,000 in the NASDAQ composite. I think 25 to 26,000 is a reasonable target, 12 to 18 months out. So, do I think we're going to go straight there? No, but I can't also understate the significance of the V-shape sell-off that we saw in the first quarter of 2025 and how many people are still not involved in this stock market. And, any little sell-off, again, maybe from a slightly hawkish Fed yesterday, slightly hotter PCE reading this morning, a little bit of a sell-off. I'll check the markets here in a little bit. Maybe it's just going to be bought up, and it just goes to show that the continuing strength. Kyle was going to put this one in here. He's shown us the CAPE ratio. And again, we'll get through the tech issues. Sorry, that will be a priority. I'm so focused on markets and running the business and rather than testing broadcasting software. That is a guaranteed promise. I'll have that up and ready to go for you next week. Kyle was going to hit this. I don't know where he was going with this one. This is the case. Robert Shiller CAPE ratio identifies overvalued and undervalued markets compared to historical mean 17. I think he's going to be showing that the CAPE ratio is going to be pretty overbought. So yeah, from a valuation point of view, we're getting a little overdone, not where we were in 2000, but looking at the forward the forward valuation, the expected earnings of the S&P averaged out over a period of time. And then are we overvalued? Yeah, potentially. We'll pull Kyle in next week and I'll have him explain what's going on with this. But, I have I have thoughts on this that, I think the technology is inherently deflationary and with, artificial intelligence and this mass computing power infiltrating so many different sectors in the economy, companies are operating more efficiently and more, they're more lean, and they're doing so with less workers. And I think it's justifying these higher valuations than what we're used to. Gross margins, I think, on the whole, are going up. Operating leverage is going up because companies are able to utilize technology to run a tighter ship. So we'll come back to that one. Those of you who followed me in the old world, this is a fun way to look at how different classes of stocks rotate in and out of favor. I worked with Julius de Kempenaar, who invented this, and he was an industry veteran for decades. And basically what happens is you watch how the markets trade in relation to each other in this clockwise fashion. And literally, if I, sent this slider back and forth, you'd see this move around in a clockwise fashion. And what it does is as markets go from this side over to this side, they're falling from the leading and weakening. This is the outperforming side of the graph to the underperforming. Sometimes what will happen is you won't get a full rotation. And what I'm starting to see here is, we've seen growth rotate out over the last 12 months. And the two yellow guys here, because they're on the right side, are Dow Jones US large cap growth and Dow Jones all capitalization growth. Over the last 12 months, we've seen a move up in the blue guys, which are value, trying to make the move over to the right, which would be outperformance relative to growth. And, what I'm starting to see is you're starting to see signs that, though we're trying to make the rotation out, which means a full-fledged move out of growth stocks into value, meaning the AI boom is on hold or is off. This was starting to set up over the last year, but you're starting to see a little bit of a hook. And it's entirely possible that you'll see this not make the full switch from growth going on the lagging side and value moving on the right side. We could see a hook up in growth. We could see a move down in value. And if that's the case, growth, you're talking, those are your AI stocks, these are your semiconductor stocks, these are hyperscalers. They're going to remain in control for the foreseeable future. And this green one right here, DJUSGM, is right here, Dow Jones US mid-cap growth. Those are your $2 billion to $100 billion companies, let's say, at the mid-cap. I generally say above $100 billion is large cap. And then, mega is, trillion. Microsoft just joined the $4 trillion market cap. So, this is something we'll watch. If these guys continue to move up and they don't, move into the red quadrant and go into leading, then that's going to be quite significant. This is down to the weekly. Okay, so each one of these little dots right here is 1 month of trading, and we had 12 months, so this is 1 year. Now I'm going to drill down a little bit and go to the last 8 weeks. Okay, so what's happened now, and this is kind of fun, like trying to think of a good example. The monthly is the bigger picture trend, but a reversal will happen on the smaller time frames. You'll start to see a significant reversal on the smaller time frames, which will encourage the larger time frame to make that full change. And we've gotten exactly that. Over the last 8 weeks, we're seeing these green guys, they were down in the weakening, the lagging, which is the worst place to be. They've emerged, they went into improving, and then they just went into leading quadrant. So when you're up here, you are showing relative strength and momentum compared to everything else. And those two green guys, USGL and USGR, are right here. Large cap growth and the growth index. And then the mid cap growth is already made the move out here. So what that means is we're seeing over the last 8 weeks a rotation into growth stocks relative to the value names. Okay, the US value index, large cap value, mid cap value, that's VL, VA, and VM, which are down here. The value group of stocks. That's that's your Procter and Gamble. I mean, that's your your most boring dividend paying, low beta, low volatility names. They're rotating out. They're not seeing as much capital inflow as your higher beta, your AI growth hyperscaler companies. We're seeing a pretty significant rotation in on here in the weekly. And what this is doing back to the monthly is further encouraging this guy to rotate up. And a very strong signal is when you get a rotation up from the weakening quadrant and we head back into leading, that I'm going to flip back to the NASDAQ chart. That is going to tell me that this is on. I believe this is on. This is not a guaranteed outlook. Anything can happen. But if that happens on RRG, the longer term, secular bull market in technology, I think is on. Okay. All right. Credit spreads. So this is the Dow in green and then credit spread. So what you do is you take it's a basket of U.S. yields, right? And you compare that to the yields on corporate debt and on the sub-investment par debt. So it's kind of hard to think about, but because if you remember back to your economics class, as the bond price went up, the corresponding yield went down, right? So if bonds are being bought, both U.S. Treasuries and U.S. corporate bonds at the same rate, both the yields are going to go down. If they go at the same rate, there's no difference between the two. Okay. If credit spreads are going down, what that means is yields on sub-investment grade corporate debt are going down faster than yields found in the Treasury. Okay. So that means there's more demand for for corporate debt than U.S. Treasury debt. If the opposite were true, if there's more demand for safe haven U.S. Treasury buying compared to investment or sub-investment grade corporate debt, right? If there are more people buying U.S. Treasuries than sub-investment grade debt, the spread between the two would go up. Okay, and you can see that as the stock market sells off, that generally accompanies a spike in credit yields, in credit spreads. And certainly that was the case in COVID. The blue one spiked sharply as COVID hit, and then we recovered, as our government stepped in on the fiscal and monetary side, and then that cooled credit spreads. Here's the 22 spikes. Credit spreads moved up as the stock market moved down. And basically what happened is in the beginning of 2025 was a pretty good sell-off. And yeah, we saw a spike in credit spreads, but we have just come right back, settling down towards the lows. Are we almost getting to a complacent point of view? Maybe. But right now there's no concern in credit spreads. And again, there's an AAII slide up here that I can't wait to show you that I think is pretty mind-blowing. So I think people are complacent, but I don't think they're bullish enough. All right. This is just the same thing, but over the last couple years. So there's the 2025 sell-off in the Dow, corresponding spike in credit spreads, and we've sold off quite sharply. Okay. All right. So here's this is a survey that goes out looking at different investment professionals and money managers and newsletter publishers, and it'll talk about what their outlook and what their sentiment is, and then it'll actually go and measure stock, bond, and cash allocations. And what we're looking at here is this is the S&P 500 in purple and moving higher, and in orange is the AAII stock allocation, total stock allocation. It dropped, of course, when we dropped in the first part of 2025. Stock market makes a new high. Stock allocation is nowhere near making a new high, and it's still below, I would say, below trend with that gray dotted line. Cash has come off, and this reading is as of the end of June. There's a lag on this report. Cash has come off as the stock market allocation has increased, but again, nowhere near breaking trend, nowhere near all-time highs. I didn't include the chart, but there's new record of money market funds, $7.5 trillion in money market funds sitting there making, 3.5%, 4% with a real yield of 2% when you take inflation away. There's so much money sitting in money markets. And we can see it right here. We're not overly allocated in terms of equities. This one really cracked me up. And this is the sentiment survey. So the last one is how much money is in stocks, bonds, and cash. This one is how people feel. And this is a much more quantitative or qualitative measure. It's loosey-goosey. This is how I feel. There's many times there's a difference between what people feel and what people do. But nonetheless, I think this is funny. All right, so before you read this, let me just break this down. So this is survey respondents who are bullish, went down. This is survey respondents who are bearish, also went down. This is survey respondents who are neutral, it went up. So, okay, so what happened is I've been showing this for the last 3 weeks. It was the bull-bear spread was hanging around zero. A couple weeks ago, it was slightly negative. We went positive, okay? And you'd say, oh, cool, we're positive. There's probably more people bullish on the market. Wait, what? It went down. What happened is there's more people who are neutral on the market. And I'm like, so this is what I wrote. As of July 17th, bull-bear spread went positive. Sorry, I was typing this quick. Above zero, but not because more people became bullish, but fewer people became bearish and more became neutral on the market. So I'm like, oh, good God. Again, the V-shaped recovery is real, and it's been so sharp and unrelenting on the upside. I hope that's the proper way to say it. It's not letting people in who are not willing to chase new highs. If you're not in and you want to get in, the way this market's acting, you have to buy new highs rather than a pullback. But the fact that more people are now neutral, which drove the bull-bear spread above zero, really cracks me up. I think the bottom line is we're a long way away from overly bullish sentiment in this market. Now, they might be right. The masses may be right, and this rally to new high may be ridiculous, but we'll see. Let's go to earnings. Microsoft and Meta just absolutely hit it out of the park, just destroyed it. The big thing was, where were they compared to expected revenues and EPS, as well as the CapEx number, which is capital expenditure on their AI build-out. Both Meta and Microsoft have been investing heavily in AI. Meta said CapEx will range between 66 and 72 billion for the year, raising the lower end of the company's previous estimate 64 to 72. So they increased their expected capital expenditure. Microsoft sees 30 billion in fiscal fourth quarter CapEx. So Meta's actually spending twice what Microsoft is. That's interesting. So here's Meta's numbers. Meta's up huge today. It was up 12, 13, 14%. The market was selling off last I checked. When I captured this morning, it was up 11.9%. So expected revenues were 44.8 billion. They came in at 47.52, which is a 6% beat. EPS, I believe this is GAAP EPS, generally accepted accounting principles of 587 expected, came in at $7.14. Like, what? They're increasing CapEx, increasing the guide on CapEx, and they beat EPS expectations by 22%. Like, that's bonkers. And you look at the history, like, not only that, but the hollow circles are the expected EPS, and then the green or red are where they actually print. Look at the volatility. Look at the beta in the EPS consensus versus actual prints over the last 4 or 5 quarters. Like, it's huge. Big delta between the two. Not beta, delta is what I should say. There's a big difference between those. So the earnings series are becoming more volatile, and that's why you're seeing a 12% move in the stock. We have a big position in Meta. I'll go over it with clients. I think it's a 2% allocation in our dividend portfolio, and I think it's a 5.5% allocation in our growth portfolio for Meta. Microsoft also crushed it. Not as much of a volatile difference between expected earnings and actual, but looking for 73.77 billion. They put up 76.4 earnings of $3.37. They made 365. So a nice top and bottom line beat there from Microsoft. The stocks are responding extremely well. So here's just a little bit of a look at Meta. As I mentioned, it's a 2% holding in TAG, our dividend portfolio, and a 5.5% holding in SIG. This is the stock reaction to Meta from earnings. So from 696, we traded up 780. Absolutely crazy. So some highlights from Earnings Hub. If you are interested, I'll pull out some highlights. 3.4 billion DAUs, daily active users across its app. Total revs, AI investment. AI is heavily investing in artificial intelligence with the establishment of Meta Superintelligence Labs, advancements in AI models, their Llama 4142. Positions the company in the lead for AI development application. I was nervous on Spotify. We hold a pretty good position in Spotify. That one missed on advertising numbers, which a lot of times is a good lead for where Meta reports, but it certainly didn't carry through. It looks like it's specific to Spotify, which for the second quarter has disappointed us. I'm going to look to pare back on Spotify. I did already reduce in Active Opps, but for 2 quarters in a row, they kind of screwed us on earnings, and they shouldn't be. So I'm getting a little grumpy with Spotify, but I'm very happy with Meta. Guidance for 2026, potential increase in total expenses driven by infrastructure costs and employment comp. So they're telling us, be careful, costs may go up, and a delayed ROI from AI. And that's the big thing, is like, when are we going to see a return on these tens of billions that they're investing in the infrastructure? But the market is giving them the benefit of the doubt for now. Let me turn that off. Oh, it recorded. Oh shoot. Let me turn that down. This video is wild. IBIT is a Bitcoin ETF holding that we have, and Bitcoin is continuing to go, and it's getting a boost because we got our first regulation on stable coins, and that is from the Genius Act. So Bitcoin is becoming more, and crypto is becoming more accepted in the mainstream. So there's a big debate, stable coins in terms of a store of value. Trump just signed it. This video of Bitcoin, I think, is pretty wild. I'm going to let this thing play. It's from this X account, x.com, APSK32. This guy's like an engineer. It's crazy some of the stuff he puts out there, but he makes a path for Bitcoin in the near term going to 300,000. And then there's another video that he has up there to 1 million. We have a 3% allocation in IBIT in our tag account. So I just wanted to play this. This is pretty fun. So Bitcoin all time, power curve support, whatever that means, time contours. He's kind of making a parallel line. These must be the halves, or the halving. No, sorry, that's the 4-year cycle. And then based on the 4-year cycle of Bitcoin, he's projecting out. This is where we are in orange, and using the prior 4-year cycles, this is where he is predicting that we go to 300,000. And that's, I think, in the near term. Let me just play that one more time. Let me see if we can get a timeline on that. So here's 100,000. Making a parallel of time contour, which I don't really know what that means, but I get the 4-year cycle. 4-year cycle begins on March in 25. So he's talking, 26 or 27. If it's a good analog, this is where it could be. So we'll see. I don't know. We're going to continue to hold it, and risk management is first and foremost within the portfolio. So I thought that was pretty wild. All right, we're going to leave this. Kyle's going to hit this part. We'll hit this one next week when I can successfully bring him on. I'm going to, because I messed up again with the technology. I'm such a loser with that. Sorry, guys. I'm going to hang on some of the investor-only stuff, but I will say this. In Active Opps, which is one of the equity portfolios that we have, this is something that's more of a, it's a speedboat portfolio. We don't recommend any more than like a 15% allocation of our investor capital to it. I did put on a VIX hedge yesterday. I'll come back and I'll show you the specifics of it. This market, based on the V-shaped recovery that I'm talking about, it's been so sharp, and any little pullback has been bought. Any bit of bad news has just been greeted by buyers as we're pushing to new all-time highs. Here's the S&P breaking above highs. Here's a more detailed look at the S&P 500. We've gone straight up. It can't keep going like this. It absolutely cannot. I fully expect at some point that we need to go back and retest these moving averages, 50 and 200-day moving average. For most of our investors, it's not a big deal. Nobody likes a 5, 6, 8% pullback. People don't love that. They like it when the market goes straight up and we make a lot of money. But if you're somebody who's sensitive to that, let us know. And one, I would say, reach out to us if you're interested in getting money in Active Opps, because what I did is I just executed a VIX call spread, which is a hedge, which I'll explain next. If a 5% pullback doesn't bother you and you're up, 50% in 2 years with us, whatever, don't worry about it, because I'm not, right? But if you're somebody who's uncomfortable with how high up we are, let us know. And one, we can get you an Active Opps so we can put the hedge on. Or, if you have enough capital and you're of, sufficient AUM with us, we can just do it one-on-one for you in your account. Okay, if you want to put the hedge on. It's not a recommendation to do so. You have to decide for yourself whether a 5 or 6, 7, 8% pullback is a big deal to you. And if it is, let us know and we can work through this. So these two charts are the same, S&P, S&P. This is the so-called VIX, the fear indicator. It's kind of a goofy name, but basically the higher the VIX goes, the more juice or the more expensive insurance options are. Okay, it's like when the foundation of your house is smoking, you call your insurance company, things are already heating up, the cost of the policy is going to be expensive. When it's a beautiful fall day and crisp fall winter day or whatever, and there's snow on the ground, chances of a fire, are low. The cost of insurance is going to be very low. Same thing with the market. When it's very comfortable up here and the volatility is very low, cost of insurance is going to be very low as well, which is the time you want to put it on. If you wait for things to get, the house to start smoking at the base, like here, you're going to be paying a lot more because you have a VIX at 30, 35, 40. The cost of insurance is much more expensive. Hopefully I'm wrong on this. I really hope I'm wrong on this and the market continues higher and I close the VIX hedge at a loss. So this is a screenshot of Active Opps. This is actually Schwab Thinkorswim's institutional platform. This is the actual trade I put on. So what I did is I went out to the September 17th options. I bought the 23 calls in the VIX, which are right here, and I sold the 29 calls right here. If the stock market does pull back and even just gives us a little bit of a pullback here, I expect the VIX to be somewhere up in here, okay? I paid, and this is, you got to understand options in a little bit, but I paid $174, $1.74 for the 23 calls, and I sold the 29 calls, which means I'm trying to capture a move from 23 to 29. My net cost is $1.74 that I paid. Subtracted, take $1.09 away. That's how much I received for selling the 29 calls. So altogether, I paid 63 cents or $63 per call spread. Okay, if 63 is how much it costs, how much I can make is $6. The difference between 29 and 23, $600 minus 63, whatever that is, I can't do that. My math in my head right now. 560 something, 557 maybe. So $550 or whatever it is that you can make if the VIX goes up to 29 right here by September 17th. Okay, so it's a low risk, high reward hedge. I expect to lose money on it, but if we do get a significant sell-off, then that should kick in as a hedge. And then you'd want to figure out how many contracts you want to do. For the entire account, I did 1,200 spreads because that was the appropriate amount. I did like a 6.5% allocation to all the clients in Active Opps for that hedge. If I'm wrong, and we don't need the hedge, I'm hopefully going to take it off at like a 3% loss, maybe half if I can get out of it in time. We'll see. We'll see. So if that's something you're interested in, let us know. If it looks like it's going to develop into a bigger pullback, I will adjust the portfolios at the model level, meaning we won't do options. I will reduce the equity holdings and then, bring in some inverse ETFs to buffer and mitigate the volatility on the downside. Okay. So I just wanted to bring that up. That's that. And I think that's going to be it. All right. So again, sorry for the tech difficulties. Again, you're probably sick of hearing that. I promise we'll have technology set up, but at least I can tell you we're more focused on markets, the presentation, getting you the information. We just gotta get the technology straight. I'll get it done. So again, hope you're well. We have 1 month of August here. We are coming to a seasonally weaker period. We do have NVIDIA earnings at the end of August, which, with this massive CapEx that's going in the way semiconductors are acting, I expect this NVIDIA report to be huge. However, has the market been bid up too much in anticipation of that? With the realization and the pill that the market's swallowing that we may not see any Fed rate cuts, we didn't really talk about tariffs. He's rolling out 15% deals. South Korea just came out this morning, India a couple days ago, Europe a couple days ago. I think we have an August 9th deal with China. The market seems to be looking past these tariffs right now. I can't believe I'm going to say it, but they're kind of yesterday's news at this point, unless something significant comes about. I'm concerned with the PCE. I'm watching that. Let's take a look at the market, actually. And there's other things too. Some earnings that are starting to show some weakness in the economy, like UPS earnings were not great. Shake Shack was not great either. So it's not all rosy. Let me do this. Let me see if I can get this back. It doesn't seem like that wants to work. That's all right. We're gonna leave it there. Let me just take a look here real quick. I'll tell you where we're at. I know you guys can't see this. Dashboard macro. Markets are quiet. Nasdaq's up 0.38%. S&P's up 0.5%. Everything looks fine. Tech is up 0.18%. Industrial is up 0.3%. Lagging on the day are healthcare, materials, and real estate, defensive sector. So everything's fine. Everything's absolutely fine. So anyways, we'll leave it there. Hopefully that was helpful. We are Inside Edge Capital. We're having a good time here. It's fun. But as I said, a lot of gratitude coming up with a presentation. The fact that, I'm able to take care of my parents' money, and, they looked at, it was actually a Schwab advisor who was taking care of their money before, charging them a fee, underperforming the market. And, my dad's like, this is, he's like, it's just great to be able to take care of your parents and take care of our clients who are, in their retirement years. And, this is a explosive market. And I really encourage you, if you're paying a 1% fee per year, and if you look at the returns that your advisor's giving you and they're subpar, below the index, it's just a chronic epidemic, I think, in the money management industry. And everything we're doing is to try to fight that, try to provide value, try to provide some protection in downturns, volatility, but really strive to outperform on the upside. There's no guarantees. I'm never going to lead on performance. We've been doing this since October 21, and we've done it. But damn, your advisor better be trying. If not, what are you doing? Kyle, big part of active management is conceptualizing risk and understanding where your financial plan, what the goal is for the different buckets of money, that make up your portfolio. So planning is extremely important. I wish Kyle was here. He'll be here next week. In fact, I might have him run the whole thing next week, and I'll be his guest. But that's a big part of it. And, in terms of our fees, we're right on par with everyone else in the industry, average of a 1%. If you're a smaller account, 1.25%. That's all in costs. So that's it. Other than that, I'll leave it there, and I wish you a good rest of the week. And I will catch you guys next week. Our technology will be on point, I promise you. All right, see you guys. Take care.